Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios today as we are here at the beginning of October 9th, 2025. We got a lot of data to cover here today. Happens to be the ninth day of the most recent government shutdown. So a lot of historical data and some context there. So real excited. This is going to be a jam-packed show. And as always, welcome back to the Shepherd Wealth Management Podcast. If you're a regular viewer of the show, thank you for your viewership. Please remember to like, share, and subscribe to Shepherd Wealth Management Podcast. As always, every 2 weeks, we dive into current news and events, but we also take a look back at see what history has to say about similar events that we're going through here today to get some perspective on what the risk and reward probabilities would be for you and your portfolio as we move into the fourth quarter here and eventually into a brand new calendar year, Q1 of 2026. We're going to cover a lot of that ground here today. This is your first time on the show. Welcome. Again, please like, share, subscribe, Shepherd Wealth Management Podcast. And I think you're going to get a lot out of today. But before we dive into it, we got some really awesome news here, not only for Shepherd Wealth Management clients, but for all those that are enjoying the content that we send out on a very regular basis. We have our first W 2 hire. This is a non equity person that we've just brought into Shepherd Wealth Management's firm. His name is Brady Jackson, and he's about my age in Louisville, Kentucky, from Indiana, went to IU Business School. And he's a great guy. He's an employee of mine when I was a manager at TD Ameritrade back in the heyday. I managed that Louisville office for about a year, and he was the best employee that I had. Gave him an opportunity here to join Shepherd Wealth Management. And he was excited to jump into that. So we're very excited to have Brady Jackson. We're welcoming him. And for all of the customers and people watching, a big part of the reason why we felt the need, to hire an employee, again, non-equity partner, but full-time employee. There'll only be two partners here, but the main reason for that, we've grown a lot. So as of today, about $170 million that we're managing for customers across the United States. We're in about 19 states, I believe, if I got that right. And we are an SEC registered investment advisory firm. So we can work with anybody here in the United States is really what that means. And as we continue to grow, we'll probably be right at about 200 million, give or take, is my estimate by the end of this year. A lot of that's going to be market performance. We're going to talk about some of that today. Certainly expect some additional business from some new clients and current clients as well. And if we are able to drive that sort of result, again, we're only 4.5 years old. As we continue to grow, I do not want the two most important things that clients have shared with us to change. The first being, I want to be able to sit down with everybody every quarter. I don't want that to change for any of our customers, both now and in the future, to ever change. I can't do my job successfully and consistently over time unless I understand the customers that I'm here to serve. So I can't have that change as we continue to grow. And of course, the customers do not want the performance to change. Most of our customers are charging us with growth. And a lot of those folks that are looking for growth certainly are looking for better than average returns relative to the S&P 500 over time. So those are the two things that we have received as positive feedback on behalf of our customers. There really aren't that many firms, if any, here in the United States that are willing to put forth that much effort in reaching out and sitting down with customers on a regular basis like we do. And very few, if any, can deliver the consistent results that we have. So I can't have that change as we continue to grow, which is why we're bringing in individuals to our firm that fit our culture and the goals that we have. And they'll certainly be there for our customers as we continue to grow. So I'm very excited to share that news, Ez.
Yeah, can't
Hopefully
wait
more
for
to come.
Brady to hop on the podcast.
Yeah, we'll see about that. He's definitely getting his feet wet here with his first full week, and we may have to make that happen here one day. But you can check us out. I think we're going to start to make those announcements more public on our website, shepherdwm.com. That should be up there shortly, as well as the social media pages, which you can all find all of those pages right on shepherdwm.com's website. So, as before we dive into the content here today, we got lucky here in Cincinnati. Our hometown Cincinnati Reds lost The last game of the year, Mets lost as well. They had the tiebreaker. We get to play the Dodgers. Unfortunately, we got swept by the Dodgers. Um, I was bullish on it because the Reds generally play, when they play good competition, they tend to play a little bit better. But it was pretty obvious to me the difference in the payroll without even looking at the actual numbers. They have a lot more Hall of Fame types of players than the Reds do. So that's just the way that went down.
Yeah, you're seeing the difference in the payroll too in the series with the Phillies that the Dodgers are playing right now. I mean, I know Phillies squeaked that last one out, but it's pretty obvious,
Oh,
like you
yeah.
said, who's fielding Hall of Famers in every aspect of the game versus who's not.
Yeah, it is what it is, but we got a Hall of Fame cast here, at Shepherd Wealth Management, and time will tell. But over the first 4.5 years of us being in business, certainly one of the fastest growing RIA companies in the industry. That's not my opinion. You can simply look at statistics for that. Average firm growth is less than 20%. There are firms that are about our size, $200 million or less. We're growing much, much faster than that with the clients that we're serving here. So, um, time will tell exactly where we will sit in the realm of the greats, if you will, the Peter Lynch's of the world, the Warren Buffett's of the world, so all those guys and gals. I certainly look up to and have a lot of respect for because they've been able to manage assets on behalf of customers over all kinds of different scenarios, different interest rate environments, different geopolitical environments, wars, recessions, market collapses like 2000. They've managed through all of that. And a guy like Warren Buffett, Charlie Munger, the main team there at Berkshire Hathaway, rest in peace, Charlie Munger. Um, they managed through all of that since 1965 to now, and the average return for a Berkshire Hathaway shareholder is 20%. And to put that into context, the S&P 500, the market, over the exact same period of time has averaged 10%. So how have they been able to more than double the performance of the stock market over that long of a period of time? In other words, they did it consistently with all of these different variables changing. And by the way, they're changing constantly right now. None of that's going to change. So, how can you, as an individual that has to deal with all of this stuff, and most of you do not want to hire somebody like myself because of whatever the reason, maybe this is something fun or exciting for you. Well, the results should dictate, how you go about making some of those decisions. But going back to how Warren Buffett and guys like him, gals like him have managed successfully over all these different variables, what have they been able to do? Well, a couple things stand out. Number one, they can admit the fact that they are human. And the importance of understanding that from the words of Warren Buffett is this: humans make a market. And unfortunately, when it comes to things like the stock market, there are two emotions that stand out that play into decisions that humans make: buy, sell, or hold. We have a lot of emotions. Science would show that there are 27 that are flowing through our minds and bloodstreams at any one given point in time. But if we're talking about investing, there are two: fear and greed. And Warren Buffett famously said, there are two things that are preventing you, the individual investor, from consistently being able to achieve the results over time that they're looking for. One is they have no control over their temperament. In other words, their emotions. That's why we're starting with fear and greed that we're all hardwired with as humans. Thanks to studies like behavioral finance, we've learned that humans feel emotional losses twice as much as they feel good about a profit. So we have to be able to control our emotions because that data is just telling you that you are risk averse by nature. So when you see scary headlines from the news, it's going to placate to that. So you have to have a process for dealing with your emotions first before you can go about making investing decisions. And the second thing that he said for investors is not only do you need to be able to control your emotions over time, but diversification. And that's what the S&P 500 is. It's 500 companies that spread across 11 different sectors in the United States. Diversification is the death of performance, and it's for those who don't know what they're doing. So you have to have a process for controlling your emotions, and you have to understand, specifically if you're trying to grow and benchmark your performance against the S&P 500, well, you can't own everything in the marketplace in order to outperform it. So that's what this show is all about, is helping you understand that that is in fact the case for every one of us that's a human and it's investing in the marketplace. We have to control those emotions first and foremost. And then we also have to have a process for making investment decisions once we've done that. And that's what we're here to do. We're here to help you guys understand what history has to say about similar events that we're dealing with today. And the beautiful part about that is if you understand how humans that make a market go up, down, and sideways, how they behaved over similar circumstances in the past, well, now you don't need to listen to the fear and greed that's going on inside of you. Now you can say, okay, these other human beings that are like me, they're trying to manage through all this. This is what they did under similar circumstances. And this is how the market reacted over the next 6, 9, and 12 months. Not only this is the market reaction, but these 11 sectors, here are the 11 sectors and how they reacted over the next 6, 9, and 12 months. And here's what the result was performance wise. What that'll do is it'll put risk and reward, the probability of making a gain right into your frontal cortex and say, okay, if there's a probability of gain, how comfortable am I with that probability being high or low or somewhere in between? Um, but also, what was the reward for taking on that level of risk? How much return on average should I expect if I go ahead and implement this? That's what this program is all about. So please like, share, and subscribe to Shepherd Wealth Management Podcast, as I believe that this will help you drive consistent results that you're looking for over time. If it's not for you, that's great. That's what I'm here for. 513-630-2664. Give me a call. Love to chat with you and see if there's a way for us to help you out with this professionally. Now, government shutdown. We are on day 9. Day 9, government shutdown. So this is not the first government shutdown in history. So there is some historical context to all of this. But I wanted to go over a couple data points first that are more, here's what's going on today, and we'll take a look at history here in just a second. So, predicting markets are showing a 96 probability that a shutdown lasts beyond 9 days. So here we are, day 9. And there's some data to talk about here as it relates to all of this. Now, this might sound bad, like bad news to a lot of individuals, and certainly some people being more affected than others right now. But we do know that government shutdowns do not tend to have lasting economic market impacts. But the reaction from the Federal Reserve could maybe be different. And we'll talk about that here in just a second. We believe that the Fed will be dovish in their October meeting. So they have a meeting coming up here at the end of October. The government is shut down. We didn't get any jobs data last week, at least not official BLS jobs data that we were normally expecting to get because of the government shutdown. That didn't happen. We believe that that would likely have the Federal Reserve continue its dovish stance and cut interest rates in their upcoming meeting here in October. We do believe this for a couple different reasons. Some economic data has weakened, particularly jobs market data and consumer confidence. We've talked about consumer confidence a lot here recently. We also think the Fed would lean dovish even without having an inflation or jobs report in hand, mostly due to the fact that there isn't a lot of layoffs happening, but there's not a lot of hiring going on either. Therefore, that squarely puts the employment mandate as the primary mandate for the Federal Reserve. So, in other words, they have two mandates, one of which is full employment, which, based on statistics and history, at 4.3% unemployment rate, that would be defined, and the Fed would agree it's defined as full employment to them, although that number has ticked up by a tenth of a point here recently. Inflation is their other mandate, so price stability. They believe over time, and the data here would suggest that over the course of time, inflation would fall to that roughly 2% target that they're looking for. They're not arguing that fact, but they're looking more at the labor market. And because we don't have any recent jobs data due to the government shutdown, they would have to continue to rely on previous data that led them to that 25 basis point cut here this September, just a few weeks ago. Now, getting back to the probabilities of this government shutdown, investors in the market, poly market is where we're getting this data from, by the way, which has generally been fairly accurate. Poly market predictions are showing that there's a 70% chance that the government shutdown lasts between 10 and 29 days. That's where I would fall, given that government employees are expected to be paid the next time that they are supposed to be paid would be next week on the 15th. I believe that that is a big reason why you're seeing such a heavy balance there of 70% of people saying that that's roughly the time period where this will end. Another 26% saying this lasts beyond 30 days, and only 4% say it would end within 9 days. I think those 4% are certainly wrong here unless something happens here over the next few hours um, of the day. Now, this will mean that we will not see key economic data before the October FOMC meeting, where they gather together to determine whether or not they're going to cut rates, hold them steady, those types of things. So we will see. We are entering a strong seasonal fourth quarter. The median gain, if you look at market history, by the way, the median return during this time of year, 4.3%, which would be a great end to 2025. This implies that the S&P exceeds 7,000 by the end of the year, which was our price target here at Shepherd Wealth Management when we wrote to clients via newsletter in January. However, as we're about to talk about here, we see this Q4, October through the rest of the year, very, very similar to 1998. And that's where I'm about to shift gears here right now. As I'm going to pull up the most recent newsletter that we have sent to clients. And first of all, in 1998, and why are we talking 1998? So those that are new to the show may not have, caught the last podcast. So there have been two times in market history, the whole market history, where the Federal Reserve waited the entire calendar year going into their September meeting before they cut interest rates. That happened two times, 1998 and last year, 2024. The reason why we believe this is more like 1998 is because the Fed cut interest rates for the first time, not in that September, but they followed through with two additional rate cuts before the end of 1998. That is what we anticipate happening here as well. Um, with the Federal Reserve likely to cut interest rates for a total of 75 basis points for the year, again, would be very similar to 1998. Now, not only did the Fed lower interest rates in their September meeting in 1998, on their October meeting, the Fed cut interest rates by another 25 basis points. Some of the rationale for that was there was some global financial turmoil. The Asian financial crisis had spread, affecting emerging markets and leading to global market volatility, which threatened the US economy. There was also this failure of the long term capital management hedge fund. And then domestic economic concerns with a tightening of domestic financial conditions and concerns about a sharp slowdown and US economic growth. That also prompted the Fed to take actions of cutting interest rates. That kind of sounds similar to what we're going through here today. There isn't any financial institutions that are imminently about to collapse. However, there are some global tensions, and there are definitely domestic financial conditions that the Fed is concerned about relative to policy decisions from this administration that they've talked about all year long, tariffs and what have you, and how that will have an impact on things like inflation and the jobs market. This is looking very, very similar setup of 1998, given all that information. Unfortunately, this isn't something that the news wants to spend a lot of time talking about. They're only talking about all of the negative things that can and might happen and maybe are happening during a government shutdown. And those aren't bad talking points. It's not like that's not true, but why not take a look back and say, where are the other points in time in history where we've been through something like this? And what was the outlook for the people that are watching our show that would actually potentially help them, as opposed to just focusing on government shutdowns are generally bad and here's all the reasons why? Maybe talk about that and then also bring in some other historical data point to talk about, because eventually this is going to be over and the people watching your shows and reading your articles are going to have to manage through all this. So again, like, share, and subscribe the Shepherd Wealth Management podcast so you don't fall victim to your own emotions. Now, given that the Fed is expected to cut interest rates, I have another bone to pick. We have Jamie Dimon, who is the world's, I'd say, most famous banker, and he's certainly running the biggest bank in the world. So people tend to listen to what he has to say, and he gets the microphone put in front of him quite a lot. However, I would love to have a live poll as for something like this, but you and I have been doing this for 4.5 years. We've talked about Jamie Dimon's comments several different times throughout the course of 4.5 years of doing podcasts every 2 weeks. Can we name one instance where this guy had something positive to say about the outlook of the stock market and investors into the future? It's never happened.
Never happened. In the 4 years we've been doing this show, I can think of 3 times off the top of my head where he's just poured gasoline on the fire.
Yeah, for what?
For no yeah, it's like he's gonna come in with some hot take, and we're all like, "Oh, cool." Like you said, one of the leading financiers, like leading the one of the biggest banks in the world. Let's get a take to maybe calm everybody down. He's just like, "Nah, here's some more kerosene in a match. Good luck, y'all. See you in a week." You're just like, "Great. Don't come back, Jamie." You know?
This is my point. They keep putting him on the show, right? They keep putting all of the talking heads on the shows. Okay, I don't care what you're watching; they're on there. Otherwise, I wouldn't be talking about it here today. The Fed themselves are saying things like, "Yeah, remember we did this podcast 2 weeks ago. The Fed chairman himself said, yeah, the stock market. If you ask me the question about the value of the stock market, it's historically overvalued." Okay, then you get guys like Jamie Dimon saying this, and I could rattle them all off. All right, I watch them every day. I do this for a living. We talk about it every 2 weeks here on this show, and I write about it every week anyway. This is why, if you're looking at this podcast for the first time, if you are a customer and you're thinking of some friend, family member, or coworker that reacts to all of this information that the news puts out there constantly, this is not only the registered investment advisory firm for you. And I'd love to sit down and help you understand more about what we do and how it would work for you. But this is definitely the podcast for you. Okay. Because Jamie Dimon will continue to talk like this, even when he's retired. I guarantee you the man will be retired a few years from now. And they're still going to put him on this program or all these programs. They're still going to take his opinion. And I have not heard him one time, not in the 4.5 years that we've been doing this, where he's had anything good to say about the future outlook of the economy or the stock market. It's either overvalued, or there's some other problem that he has, whether it's geopolitical, Fed, or otherwise. But
It's gonna be
this is
even worse when he's retired because no one's gonna be able to keep the mic out of his hand. He'll
this
probably
is
have
true.
his own podcast that we'll be competing with.
Yeah, I'd love to have him. I'd love to do an interview with him. But I will say this, I had to spend 1 year not doing this job. I had a 1 year non compete when I was, leaving at the time TD Ameritrade as Charles Schwab was acquiring them. I had to sit out, if you will, for a year and work in a different field. Well, the field that I was working in, I was selling software directly to bankers, CEOs of banks, community credit unions, local banks. Some of them well over $1 billion in assets, some much, much more than that. And the common denominator for every banker that I've ever met with is they're the most risk averse people on the planet. They would basically want to take no risk or close to no risk as possible and generate the most return as possible, right? There's the summary characteristic of every banker in the United States for sure. It's hard to say the world because I've never done banking outside the United States, but they're probably similar. So that's the person characteristic wise that you're listening to here. And here's what he had to say. So this is a CNN article. The title of this, and this was written just a couple hours ago by John Tofite or something like that. The title was this: Jamie Dimon is worried about a stock market correction. Well, when the hell isn't he worried about a stock market correction? And this is going to get into some other topics that we want to talk about here today regarding artificial intelligence. So Jamie Dimon, chief executive of JP Morgan Chase, said he thinks artificial intelligence is real, but some money being invested now will probably be wasted. Take AI. There's a lot of money going into it. Dimon said in an interview with BBC, AI is real. AI in total will pay off, just like cars in total paid off and TVs in total paid off. But most people involved in them didn't do well. I am far more worried about that than others, Diamond said. I would give it a high probability that I think is probably priced in the market and by others. The level of uncertainty should be higher in most people's minds than what I would call normal. He said, adding that geopolitics and government debt burdens are contributing to the uncertain outlook. So, again, going back to last week's podcast, these professionals, it doesn't get any bigger than Jamie Dimon in the finance world. Okay. But there are a whole bunch of professionals, and this article included. I'll give you the person here. I'm not going to pronounce their name correctly, but Christilian Gregorvia, as a managing director of the International Monetary Fund, said in a speech Wednesday, fired up by optimism about the productivity enhancing potential of AI, global equity prices are surging. Today's valuations are heading towards levels we saw during the bullishness about the internet 25 years ago. If a sharp correction were to occur, tight financial conditions could drag down world growth. So, again, they don't get any bigger name in finance than Jamie Dimon. Here in the CNN article, we've already quoted him. And then an additional professional. I mean, this person's title is crazy. International Monetary Fund. They're the director of that. That's a hell of a title. All right. So you put these people in news articles on TV, the Fed chairman, Jerome Powell, Jamie Dimon, all these major money managers managing money globally. And they're saying stuff like this could happen, this may happen. I'm worried about whatever. You're a human. I just told you you're going to feel losses twice as much emotionally as you feel good about a gain. You hear all these professionals saying something like this. What do you think your natural reaction would be if you were left all by yourself in a room to make decisions with your money? You're either going to do absolutely nothing because you're paralyzed by the fear of either missing out if you're wrong or they're wrong in this scenario, which they've been wrong a lot, or you're going to be afraid of losing your nest egg, right? So how do you make a decision? You just do nothing. That's the majority of people, by the way. There's a whole other cohort that'll sell, and there'll be like a lot of people, 7.4 trillion sitting in cash in a bull market where the S&P 500 is up 14% year to date. You missed it all if you're sitting in cash, by the way. And as a comparison, professionals, so the difference between the stock market's return and a professional like Shepherd Wealth Management's returns is what we call value. The average return for our customers, net of fee, from the beginning of the year till now in 2025 is north of 30%. So more than 100% better than the overall market. That is what we call value. That's the value of working with a professional that understands how to manage through this, just like it is valuable to have a guy like Warren Buffett in your corner throughout your career. You can point to a whole bunch of other people as well. But there are fewer folks like a Warren Buffett than there are like Jamie Dimon, who generally looks at things from an emotional lens. And again, these professionals, all they seem to want to point to is equity valuations. It sounds like they're super smart talking about the valuations of the market historically. The market's PE ratio is 16 and a half times, and today we're over 20. That means that this has to correct. In other words, these people won't make a buy decision unless the market on average is trading at about a 16 PE. That would imply that you missed every bit of return for the Mag 7 for 25 years. What's the opportunity cost on that? It's a lot. It's a big reason why 74% of Americans say that the number one stress in life is their personal financial situation. Well, I wonder why the hell that is when you got all these professionals on here talking about how terrible the market environment is because things are too expensive all the time and therefore correction is imminent. Doesn't make any sense, folks. Let me give you some real statistics here since we're talking about artificial intelligence. Analysts at consulting firm Pantheon Macroeconomics, it's a cool name, estimate that the stock market's enthusiasm for all things AI has added some 8.5 trillion in aggregate US household wealth since late 2022. The S&P 500 returned about 70% between the start of Chat GPT mania, which was roughly around the end of 2022, to the end of Q2 2025, with roughly half of those returns generated by the Magnificent Seven. Again, if you are just going to sit here on a soapbox and talk to me about price to earnings multiples for these kind of companies, we'll just stick with the Mag 7, and you're going to sit here and tell me you're the banker of bankers. Those companies don't deserve some sort of premium. I mean, is anybody in the media going to ask follow-up questions? Is really where I'm coming down to. And by the way, in this article, the CNN article that we've spent some time here today talking about, there isn't any relevant data that he's pointing to support his thesis. And if you go back and look at history, that's what you're generally going to see. And why do you think it is that all these smart people, and maybe even you personally at home, consistently feel like there's some shoe getting ready to drop in the marketplace, even when things are great like they are right now? It's because we're humans. We're afraid of losing what we've gained. It has everything to do with your behavioral finance, right? The hardwiring of how you were created. If you can't control that, if you do not have a process for controlling that, it's going to be extremely difficult for you to be able to achieve the results that you're looking for consistently over time. Now, getting back to the newsletter here, we mentioned that this is, in our view, very similar setup as 1998. Well, in 1998, um, the best month performance wise for the entire year was the month of October. October was up 8% in 1998, followed by November being up 5.9% and December being up 5.6%. So here's the information. That's 1998 Q4, last 3 months of the year. Awesome returns. Since 1950, the months of October through December have posted an average gain of 4.9%. That's great. If we were to see the average return or something similar to that from the S&P from October through December, that would put the S&P at 7,050 by the end of the year. So a little bit more than 7,000, which is about where we called for out of the S&P earlier this year in January when we wrote to clients. However, if we were to get returns like 1998 in October, November, and December, which we're not calling for, by the way, that's a lot of return, almost 14% return, if that were to happen by the end of the year, which would be great. I'm not going to sit here and try to hold the market back from that. Our customers would love it. I know I would. But that would imply that the S&P would reach 7,750, or roughly 1,000 points above where the S&P is trading at today. So we're not calling for 1,000-point move of the S&P, but there is your likely ranges of outcomes based on history. So as I mentioned earlier, what is the risk and reward of participating in the market today? Because you got all these other professionals, markets overvalued, corrections are coming. This removes all of that nonsense, right? Because they're not pointing at anything. It's just how they feel personally. Well, if the outcomes based on history are likely going to be somewhere between 7,000 the S&P and 7,750, knowing where we're at today, there's gains to be had. What is the risk of participating in this market would be the other question. Okay, we understand what the reward might be now, but what's the risk of participating in it? Well, if you agree, and the probability markets do agree that the Fed is going to cut rates in October, and there's greater than a 60% chance of a cut in December right now, well, the Fed has cut interest rates at all-time highs before. There's historical precedent for this. And since the S&P 500 returns after Fed cuts are within 2% of all-time highs, just like today, take a guess what the probability of success was over the course of the next year, 12 months out. There's a 100% win ratio, meaning that there wasn't any negative periods in the entire history of the S&P 500 when the Fed has cut interest rates, where the S&P is within 2% of an all-time high. There has never been in the history of the S&P 500, 12 months later, the market was worth less than it is today. So 100% win ratio. If you are a long-term growth-oriented investor, is there risk of participating? There's no historical risk. Could this be the one time in the history of mankind where this is the one instance where it bucks that trend? Yeah. You can't say that there's no probability of that happening. Could. It's a pretty bad bet to make, right? Given all the history that I'm looking at here. But what was the average return 12 months later when the Fed has cut interest rates, when the market is within 2% of an all time high? Not only is it a 100% win ratio 12 months from now, historically, but the average return was almost 14%. What is the risk and reward characteristics? We just defined it for you. It's just a question of whether or not that risk and reward works for you. Now, let's say it does. I do want to participate. I haven't participated all year long. Now this is starting to sink in and make sense. Where do I go? Well, let's take a look at what history has to say. You could just participate in the S&P 500 index or the Russell 2000 index or the NASDAQ index. Nope, nothing wrong with that. But go back to what Warren Buffett had to say. Once you've controlled your emotions, which is step number one, we've just done that because we now know what the risk and reward is of the S&P and participating in over the next 12 months based on this historical data. And let's just say that that works for you. It works for me. It certainly works for our customers here. What do we do now? Well, historically, Trump's first administration, the top four performing sectors were technology, consumer discretionary, financials, and industrials. The order of which of performance, best performing being technology stocks, followed by consumer discretionary stocks, followed by industrial stocks, followed by financial stocks. And historically, second year of a presidential cycle, if you're looking forward into 2026, generally very good. We'll talk more about that here in coming podcast. Earnings season, awesome. We're about ready to kick that off. We have kicked off some earnings already. They've been great. A lot more to come next week. But I just gave you the sectors, the top performing sectors, and historically, if they cut rates two more times this year for a total of three in 2025, markets right now believe four cuts are coming next year. Well, what historically does generally the best over a shorter period of time frame, like 12 months or so? Small caps, small cap companies. Just check it out. And by the way, half of that index, if you're looking at the Russell 2000 small cap indexed ETF, half of that index is industrials and financials, smaller industrials and smaller banks. I just told you those are two of the better performing sectors historically under Trump's first administration. Right? We've now just defined what the risk and reward characteristics are using data, historical data of other humans reacting under similar circumstances to the Fed. And here's what the outcome was. You don't need to listen to Jamie Dimon or these other people who are quoting these articles. You can. There's nothing wrong with that. You can go and test, what they're having to say, but there's nothing to test because they're not pointing to any other data. I'm just taking their information saying, what does the market history have to say about this? Well, we just talked about it here for 30 minutes in today's podcast. So please like, share, and subscribe to Shepherd Wealth Management Podcast, friends, family members, coworkers. That way they don't fall victim to their own emotions. We want consistently good results here for our customers. And last but not least, do not expect a lot of dips in the S&P 500 for the remainder of the year. A lot of that has to do with the cash sitting on the sidelines, and the fact that there is not a lot of margin borrowing going on from investors right now. So if you're not participating in the market and you're trying to figure out a way to get in, I would recommend dollar cost averaging into the sectors or stocks within the sectors that you want to have exposure to, that where you're not falling victim to another trap, which is trying to time the market of when to buy, sell, or hold. You're much better off to be in the market than trying to time the market. We've talked about this many times before, especially in the early days of Shepherd Wealth Management when we were dealing with 2022, which was the worst stock market year since 2008, which was our first year in business. Yeah, it was a tough time to be an owner of a wealth management company for sure. But if you were to miss just the 10 best days in the stock market, I mean, your return basically gets cut in half. And that's over a very long period of time. So, getting back to a couple other data points here. The government shutdown, as we talked about, likely going to be temporary, but this is to be determined. We'll find out as the days go by here. The Fed's likely to be cautious, as we talked about, which would definitely be supportive of risk on assets. Historically, shutdowns have not led to prolonged downturns in stock markets, and of course, we're very optimistic that this time around won't be much different. But there are some historical precedents regarding government shutdowns. U.S. government shutdowns, again, usually have little impact. And here's what the data shows. In all instances of government shutdowns, the 1 month post shutdown return on average was 1.2% positive with a 60% win ratio. And if I were to like not look at all instances, but what we would define as instances where it's similar to other government shutdowns, you're still looking at positive numbers here. Average returns well north of 1% with a 60% win ratio. So all the news headlines are certainly going to be very scary, and certainly some households in America are being personally impacted more than others. But if you are a long term participant in the market, here's the data. There's not a lot in the short term to be super concerned and cautious about. And with all that information, we're about to kick off earnings season, as I mentioned. So we're going to be talking about this regularly on the Shepherd Wealth Management podcast. So 2 weeks from now, we're going to be right in the thick of it. It's going to be tech earnings season time. We've already gotten through banks, earnings information. We're going to be coming up on a Federal Reserve meeting a couple weeks from now. So this is very important stuff, and a lot of important information is coming your way over the next several weeks, all the way through Thanksgiving and right up until Christmas. So please like, share, and subscribe to the Shepherd Wealth Management podcast because we're going to cover it all. And we're not only going to cover it, we're going to give you our historical look at it, what we're doing, what it might mean for you personally. So we look forward to seeing you guys again here in a couple weeks. Love to answer your questions. You can leave them right here in the comments section on YouTube. You can certainly go to our website, as I mentioned, shepherdwm.com. Find all the information about how to get a hold of me, learn a little bit about the firm as well. And we'd be glad to address those questions on our next episode just a couple weeks from today. So hope you guys have a great rest of your Thursday, October 9th, and we'll see you again soon. Take care.